How did you get your start in venture capital?
Well, I was running a public portfolio, and one of the board members and leaders at Wasatch Global, and I was running a fund called the Ultra Growth Fund. So it was an aggressive sort of small cap, high growth public strategy.
Oh,
And
interesting.
yeah, that's
That's
what I
cool.
spent most of my life doing. So I started at Wasatch straight out of the University of Utah undergrad. So Sam Stewart, who's passed now, but was the founder of Wasatch Global, was an adjunct at the U. And actually, the three kind of there was four kind of managing partners for a long time at Wasatch Global, and Sam and three young people, two of which he'd hired out of his classes as an adjunct at the professor, myself and Jeff Carden, and then Robert Gardner, who he had hired from his neighborhood. So that was
Mm,
kind of the story of Wasatch. So he had hired me out of class as an undergrad, and I became a public manager. And I was running the most aggressive kind of small cap growth fund, and had built that from launch to about $1 billion in assets under management for Wasatch. But post the .com bubble burst, seems like ancient history now, and I guess it is. I'm dating myself, but there's a lot of new regulations. So
yeah.
Sarbanes-Oxley and Regulation FD, and probably the one no one talks about, but was the Spitzer Accord, which was the settlement between the major banks and the SEC. All those things made it more difficult, more expensive, and more risky for companies to go public. And so Wasatch is a small and microcap focused public growth manager. That was a pretty negative situation.
Yeah.
And so we just became worried. The fund I was running in particular was our most aggressive product. And a large percentage of the companies in my portfolio were recently public. So public within the last, call it, 2 or 3 years. And so the idea of companies coming public 2 or 3 years later was really my inventory or my deal
Yeah.
access. And so, we got a little bit worried about that. And, we had this thesis that companies were going to stay private longer, which, directionally are accurate. But in terms of magnitude, we obviously had no idea, that
Yeah.
companies, through most of my public career, companies came public when they were worth maybe 300 to 500 million. That's market cap, not revenues.
Yeah.
And now the bankers are telling companies they need that kind of revenue to go public, and they come out worth, billions or tens of billions. So we kind of had that thesis that companies were going to stay private longer, and that was problematic because, when they did finally come public, we needed to have higher conviction, and we needed to not just nibble at the IPO, but we needed to know these companies and lean in more quickly. And so getting to know them seemed important. The
Yeah.
other issue is these are competitors. These are competitors to our public holdings. So we had a growing blind spot is how we thought about it. More and more larger private companies that were material competitors to our small cap public holdings that we didn't see.
Right.
And so, we just felt we needed to get more visibility on these late stage private companies that were staying private. So that was really the start to Cross Creek, and it was never intended to actually be a product. It was literally, we need to get to know these companies. It was a research strategy. Let's get to know these companies while they're private before they go public. When they go public, we'll have some time and grade with these companies, and make quicker, more conviction decisions on the IPO and shortly after, and have visibility for other companies we owned. But you find out pretty quickly that you don't get any visibility in venture without a checkbook.
Yeah.
Yeah. And so, we started getting some opportunities, to invest in companies, and we started making some private investments with our mutual funds, which was a good testing ground, but not a long-term strategy. Because, a mutual fund is a daily liquidity pool. Every investor can buy and sell every day.
Yeah.
So you can imagine if you have a lot of illiquid investments in there, that's highly problematic. So it was a very small percentage, mostly of the billion-dollar strategy I was running. We started making some private investments, getting to know VCs, and ultimately decided to raise a dedicated pool, which was in 2006. We'd been doing private investments for a few years after .com and the mutual funds. And in '06, we raised our first dedicated fund to do really pre-IPO direct investing.
And
So
is that
that's
when you called it Cross Creek? Was it 2006?
yes, we called it Cross Creek from the beginning. And the reason we didn't call it Wasatch Ventures is one, at the time there was a Wasatch Ventures,
Yeah.
which people
Yeah.
may remember. So that would have been confusing. And the other reason is a private fund, a private investment vehicle is not available to retail investors, as you know. And so we didn't want to create any confusion because Wasatch had tens of thousands of retail mutual fund investors. And we didn't want them hearing about our new venture fund and calling up and saying, I want to put $100 in your new venture fund. So we really needed to kind of isolate the program, offer it only to our qualified institutional clients. And so for multiple reasons, we went with Cross Creek.
Yeah.
And we've been Cross Creek ever since.
Is there like a creek that it's named after?
Not really. We wanted it to sound kind of mountainy because of Wasatch Mountains and the cross, we're focused on companies trying to cross from private to public. So we ended up being Cross Creek. It's also, there's a lot of other names considered, but, we looked them up and they were all taken because there's a lot of VCs out there. So
yeah, there are. How many VCs were in Utah, though, in 2006? Not that many.
Probably 4 or 5, and maybe there was some other small ones I wasn't aware of, but there was only a few. What
do you think has changed since you started in 2006, the venture fund? Like what has changed about venture? Both, kind of at a macro level and then also just, at the state level.
Maybe, we're not regional investors, so I'm probably better at the first part of the question than the second. At a national level, look, this idea of companies staying private longer, this late stage round that was really a pseudo IPO. So it was a round that was happening in, one more round instead of going public and then going public later. That was really new. There weren't a lot of investors focused on that stage. There was some growth funds, but it was a little earlier focus than what we think of as sort of, really late stage venture growth now. The public funds were not involved. So the huge involvement with, the public mutual funds, the Wellington Fidelity, Turo, that wasn't a thing. There had been some public involvement pre.com, and it had not gone well. So the few public investors that had been playing had really, they'd gotten burned primarily for getting too many illiquid assets in a public pool and even had some SEC challenges. So the public involvement was, so I think this stage of investment was pretty novel and new when we started. And now, of course, it got very, very crowded with a lot of non-traditional venture capitalists, the public funds, the strategic funds, as well as, most of the major venture funds of any scale have raised, opportunity and opportunity plus funds.
Yeah, it's crazy.
To really go after this additional round. So I think that's been a big change from our perspective, like in terms of what's impacted us, the kind of thing we were targeting, has really changed. And I think the one thing on the history that I hadn't really mentioned is initially we were just doing direct late stage company investments, but pretty soon after our formation, we started investing in funds. So we started investing in funds, primarily funds that do early stage. And the reason, I wish we probably should have done it backwards if we'd really been, organized and thinking about it. But growing up in the public world, we were used to having a Bloomberg and knowing every company and knowing everything that everyone else knew about every company. And all of a sudden in private, it's a whole new world and it's all relationships and
there's no such thing as that, right? Like, Crunchbase tried to do it, PitchBook tried to do it. Not really.
Not really. You can get lists of companies.
Can't do it.
You just don't have the numbers. You don't really know how big they are, how they're doing. And so, by investing in funds, we really we call it our private Bloomberg. We've kind of built this visibility database. And it's not just visibility, it's access. Because just because you know a company's doing well and it's getting to that pre-IPO stage, how do you get introduced? How do you connect with them? So for visibility and access, we ended up sort of building this adjacent fund of funds program, which, has turned out to be critical, I think, to our strategy to get, access nationally to the top pre-IPO companies. But it's gotten, even with that, which I think makes us very unique versus a lot of the other players, it's just the growth stage has gotten very, very competitive.
Oh, for sure. It does seem like the seed stage is kind of getting left out in kind of like all of the kind of big funds, or even, funds that started at seed, Series A, in order to get a new fund and to just take advantage of the opportunity. They kind of have to move upstream, which kind of does leave a bit of a dearth in the early stage, meaning like that $250K, $500K, maybe $1 to $1.5 million check. I don't see those getting written as much anymore.
That's interesting. You're absolutely right that, most of the brands that we grew up with, maybe they still have a pre-seed or seed program, but junior people, no one really wants to work with them. It just doesn't move the needle for them. A lot of them are actually investing in other funds. So they'll invest in tiny pre-seed and seed funds to kind of be their farm team. So I think you're right. A lot of the big funds have just outgrown, being able to invest in that stage. But on the flip side, there's just thousands and thousands of these new managers springing up. Not all of them are pre-seed and seed focused, but the majority are, because that's the place that they can get access.
Yeah.
Hard for them to compete on a competitive series, A even, let alone, B or C with all these big brands. But, I think the regional focus funds, or really where we're seeing a big rise, is sector specific funds. So, taking seed money or pre-seed money from the guy next door is not as popular as it used to be, because the combination of just the connectivity of the world and COVID, everyone being much more comfortable writing a check over Zoom, has really made the regional a little less, dominant. But what we're seeing is the rise of specialists, that the entrepreneurs, if it's a cyber company, they want that cyber expert that's built been on the board of two big cyber companies. I mean, biotech's probably the most obvious example. Like, the generalists just aren't really doing biotech or something that specialized anymore. So we're seeing a lot of new funds, actually, many of which are early focused, but they tend to be very focused on an area, and that's how they're getting their access. Is hey, they may not have the big brand, but they're really good at one thing.
Do we have too many venture funds?
Yes.
Yeah.
And I think we're going to have boatloads of zombies. I mean, I think fundraising is very difficult right now.
Yeah.
The liquidity back to the LPs has obviously been, I think like 15-year low last year. The LPs, they don't have infinite money. They can only redeploy the distributions they're getting. So I think fundraising's gotten difficult. And when that happens, the institutional LPs, they don't want to lose their top relationships. They're going to stick with those. And the newer, smaller funds or the underperforming funds are just really struggling to raise. And the mega funds actually are struggling to raise as well.
Yeah.
They're raising their big opportunity or their mega fund. If their performance isn't there, some of the largest funds have not, hit their target. So I just think there's going to be a lot of funds not able to raise. That fund twos and threes are always hard because the track record's just too immature. Like, maybe you've got TVPI, but right now nobody believes the TVPIs anyway. Mm-hmm. Everybody's focused on, have you really given money back? Do you have DPI? And there's just so many of these funds that they may have great portfolios, but it's really hard. It's everyone wants to wait until they give back some money, and I think a lot of people are struggling to raise. So I think we're going to have a lot less funds.
Yeah, it seems like it seemed like 2 or 3, maybe 4 years ago, or I can't remember the exact time frame. Literally everyone was launching a fund, or was getting offered a fund, or at the very least doing a syndicate. It just seemed like there were so many of that. I was like, man, this is crazy. Like,
every CEO that had an exit and had a little money was putting together their own fund, and lots of operators turned VC, which, there's some great success stories in that, but I would say the batting average is pretty low. I don't know that, look, it's great to have an experienced operator, on your board. And I think that story is really interesting to CEOs and entrepreneurs. But in terms of being pickers and sourcing, The track record's pretty mixed. I think a lot of those funds won't make it. But the corporate funds too, and just so many new funds and family offices getting super involved in venture.
Yeah.
It's been pretty hectic, but things are changing. I think the bar's just a lot higher now.
Yeah. You mentioned that you're not a regional fund, and I wonder, was that intentional from the beginning to not be a regional fund, and to really regional funds are really interesting because they're obviously great for that specific region and ecosystem, right? It's really cool to have a fund specifically focused on Utah or specifically focused on Austin or whatever it is. They also have a mixed track record. Like Austin Ventures went under, right? Like it's not obvious once you put like, we only invest in this one particular place. You are limiting yourself kind of unnecessarily, right? So anyways, how do you think about that, and what was your strategy?
We are very narrow in terms of stage. So we only do late stage companies that we think have IPO potential, which in terms of, the number of venture companies that get some sort of, funding, it's probably 1 in 100, right? That's ever going to get to that credible pre-IPO stage. So we're very limited. We never considered limiting ourselves geographically. Because if you think about, how many companies have come public in Utah in the last decade? If we limited ourselves to Utah and pre-IPO, we'd have like one opportunity a year or something, maybe two. Yeah. So no, look, given our history as a public investor, Wasatch is not regional at all. In fact, I'm surprised sometimes how many Utahns have never heard of Wasatch. Global, it's a large firm. It's been around a long time. But they're very national. Their client base is very national. Their investments are global, and actually their client base has become global too. If you were to look at their clients, their investments, you would never guess they were based in Utah. They just have a global perspective, and always have. They always have. So that's where we grew up. We were looking for pre-IPO investments. That was where we went narrow. Frankly, we did some earlier investments. In the beginning, and we were no good at it. We're not, we're good at identifying companies that have products and customers and financials, and we can use our public company investment lens. When you apply that lens to a startup, it didn't work very well. Yeah. So we quickly narrowed our focus to companies that we could use the diligence style and the methodology that we'd grown up with. And that put us in late stage. So we're mostly U.S. We've done some in, developed markets, Israel, and, we'll do some things outside the U.S., but we're primarily pre-IPO. If we do something outside the U.S., it's probably a company that plans to go public on a U.S. exchange, because that's where we can be helpful.
Yeah.
But as far as our perspective as a LP in funds, we've backed off of the regionally focused funds, as I mentioned. I think the sector focus is more interesting to entrepreneurs than just because someone lives by you, they're not necessarily your right investor. I think they're much more interested in a sector specialist than a neighbor. And I think people are just far more comfortable building relationships, over Zoom, and I think COVID really pushed that forward quickly. So we have done some regional. We will do a regional manager internationally, like to say, like a fund like like an Altos, which is a fund people know well that's been very successful, like Altos Korea. Everybody's not going to fly in for the A, in a geography like that. But in Utah, will California people not come in for the A or for the A round? Of course they come in, right?
Yeah.
So I think within the U.S., we're not really, we're much less regionally focused. And even in Europe, I think there's still some, there's some countries that are more insular, like France in particular. I think because a lot of the money to the venture firms comes from the government.
Yeah.
And they put restrictions on what percent has to be local. So there's some specific reasons. And I think just culturally, there are some countries in Europe, but I think even Europe has become much more sort of pan-European funds. And we just think the regional specialties may be a little bit dated.
Yeah. Yeah. It might be. Yeah. which is really interesting because there's a lot of funds that focused on regions.
But name one that's done well. I mean, there's some early ones that I think are doing really well, but in terms of a fund that's, let's call it really mature, like 15, 20 years old, they have multiple funds that are like wound down or close down, like they're baked. Who's done well?
That's a good question. I have no idea. Can you name any?
Not really. I mean, there's a few, but for the most part, it's been, there's some that have done well, but I wouldn't say, I wouldn't say on average, I think that the track records have not been, and maybe it is because they're limiting themselves. It's a tricky question. We do think for the very earliest stage, for pre-seed and seed, I still think, regional can make a lot of sense. But I think there were very few funds that were just doing that historically.
Mm-hmm.
And I think just anything beyond that has become a competitive national market.
Yeah.
And so I think those funds that were relying on region to be their competitive advantage, I think it's been a challenge. But I'm optimistic that some of the ones that are really incubator type funds, I mean, I look at some of the incubators, which is maybe a different model, are regional and I think have done fairly well. But that's a different model. Yeah. Services, a different model altogether.
How do you, what's going on in the public markets?
Well, it's a bit of a roller coaster.
It's crazy.
I mean, I don't spend as much of my time focusing on public, obviously, as I used to, but it was such a surprise, how resilient the public markets have really been, how quick things rebounded. But maybe the public markets are pretty darn smart. And, everybody was saying recession, and the public markets were saying, I don't think so. It seems like they're right, at least so far. Now people are saying, hey, recession again. So I guess in a lot of ways I was very skeptical about the resiliency of the public markets, but I think so far they've been right that this economy was much more resilient than people expected, especially in the headwinds of dramatically rising interest rates. I think it's almost unprecedented for the economy to sort of withstand that as well as it has. So,
what are we in for as somebody who looks at this? And obviously, in the United States, we're in the midst of a presidential election, which adds some uncertainty. I think the wars probably add even more uncertainty with what's going on in Ukraine and Israel and the Middle East. We're not the only country going through a presidential election either. There's 20, 25 around really important ones around the world. What are we in for here? Like, how are you looking at 2025? Like, first quarter of 2025, what does that look like?
25. I mean, I don't have a crystal ball. Obviously, what happens with the election, for certain industries, for some industries won't matter, but for certain industries, obviously that's going to make a big difference in terms of the outlook. The IPO market, which is probably the part of the public markets we monitor the most closely, has had a couple of sort of false starts here over the last 18 months, but really hasn't gotten any wind in its sails, for a couple of years now. So, I think that's one thing that there are a lot of companies that are IPO scale. A lot of them, their growth is slowed. They've tightened their belt. They don't want to raise a down round. So they tighten their belt and slow their growth, which makes them, less interesting in IPO candidates. But there's still a lot of them out there. The public valuations have been reasonably resilient, but the market hasn't really been strong enough to support, the IPOs. So we'll see. I mean, maybe with the, wherever the election goes, I think the thing the public market hates the most is uncertainty.
Yeah.
As a public investor, I used to say, it doesn't really matter, what the regulation or the political environment, it doesn't really matter, what it is, just let's get it resolved. And once I know what I'm dealing with, you rebuild all your models and you change your forecasts and you start, you reset your valuations for whatever's happened and you move forward. But uncertainty, the public market struggles with. And of course, when volatility's up, that's always your biggest risk for a major crash. So whatever happens, maybe if things just stabilize, then we can, get the IPO market rolling again. And
is it good that it's harder to become a public company, or that there are some real advantages to staying private now that maybe people weren't looking at a decade ago?
That's a great question. It's a very hard decision to go public. It's not fun. It's expensive, it's risky. And, well, you're at a private company and you have an aggressive plan and you hit 90% of plan and the board's like, great job. You grew 50%. You're supposed to grow 60 or 70, but you grew 50. We're doing great. Do that as a public company and your stock is going to get slashed. You're in the doghouse for 18 months of having to hit. It's a hard life. And I think, companies are waiting, one, because it's tough, and two, because they can. There's been so much private capital. Why go public when you can get a higher valuation and a big round from many of the same investors? So, a lot of the public funds have been putting a lot of private capital out. So the same investors, maybe your VCs or the opportunity fund of the VCs come in, but a lot of it's coming from the same funds. And you're staying private and not having the expense and the, basically the headache of being public. I think it's been a great option and people, took it. But it runs out over time. Some of these companies can do a private equity, change of control. The venture funds have timelines and a lot of those timelines are running thin. We are seeing, private equity. Private equity still has a lot of capital, but private equity is only going to step up for a certain type of company. Mm-hmm. They're going to step up for that profitable company. It doesn't have to be growing at venture rates, 20% and 20% EBITDA margin. Great. PE's all over it. But, those venture companies that still have high burn and high growth, that's not a PE deal. The public markets haven't been open for that deal. And those are the companies that have really been struggling because they don't want to raise a down round. They're not a PE candidate. They're not an IPO candidate right now. And so they've had to tighten their belts and then lower their growth to where everybody's been targeting control my own destiny. The board members are all saying, hey, control your own destiny, get to break even. We're not a fan. We think that's not great advice because it's a bridge to a pier. So great, you become break even, but you've slowed your growth to 10, 15%. Nobody cares. Nobody cares about that company, right? It can be
That's an interesting perspective to that.
Well, no, let's say a company's even pretty big. Let's say it has 200 million in revenues. And you manage to tighten your belt, get to break even, but now you're growing 10 or 15%. PE is not very interested, not an IPO. VCs don't want to fund around on a 10% grower. Where do you go? A lot of those companies are going to debt. And that's a dangerous game. Yeah,
that is super interesting. That is a fascinating perspective that I don't think is being talked about enough, actually, because everybody is saying, control your own destiny, slow down. That is a fascinating perspective.
But then what happens when you get there? And then, so from our perspective, we're like this late stage investor, and they're saying, hey, we want to raise a round to reaccelerate our growth. Reaccelerate your growth. This is a new model, right? There's not people out there that say that's what I invest in. It's hard. You've let probably a lot of your top talent go, or they left because you're not exciting anymore. Their options are out of the money, probably worthless. The common stock's worthless because the stack's too big. So your talent's left and you're trying to raise new capital. And remember, your management team that's there, probably needs some sort of top of carve out. Their options aren't worth anything. So it's a tricky game because, they want to reaccelerate their growth, but it's a hard equity call to make. And so I think a lot of those rounds are going to venture debt, convertible debt. And, that's tricky. These companies are break even. They're not really in a position to pay back debt.
Yeah. Yeah. Everyone should remember what you just said. That is really, really fascinating. As you think about the state of the private equity market, how do you think that's going? Is part of the reason why we're not seeing as many IPOs because of private equity, or are those two not tied to each other?
That's a good question. Maybe that's a reason. There's certainly companies that, are getting acquired. In fact, in our portfolio, one of our probably our leading IPO candidate just got bought out by a UK private equity firm. It's a company that absolutely, even in this market, had a chance of going public. It had the kind of profile that, this market's open, just the crack, and the kind of company that might have been able to sneak through. So there's definitely some of that, but I think a lot of these companies just aren't in a position right now to go public because they've slowed their growth, or maybe they are in a position to go public, but they don't need to. So remember that company that actually has gotten profitable, and is growing. They don't need capital. They don't need to go public. So their only reason to go public is that the shareholders want liquidity. Maybe they get through private equity, or maybe they just wait. I think a recent IPO that we're not involved with, but I thought was interesting was OneStream. It's done all right, but that's the company profile. Big, profitable, still growing quickly, that can get out, and you kind of ask, like, why do they go public if they don't really need to raise capital?
Yeah.
So I think that's, sort of multiple reasons. PE is providing liquidity. Some companies just probably can't. And then some companies just, why test this market, right?
Yeah.
Why test the waters if you've got cash?
Yeah, if you don't have to, it doesn't make sense.
Yeah, if you've got capital and you don't need to, who wants to be the one to go in the, shark-infested waters right now?
Oh, for sure. When you are looking at a company, specifically Cross Creek, what are you hoping? Are you hoping they go public in a certain time frame? And what type of fundamentals are you looking for there?
We absolutely are looking for companies that would be high caliber IPO candidates within the next 3 to 4 years. So that is a critical criteria. And what metrics are required for that does vary somewhat by industry. Typically revenue scale. But if it's a company that's, maybe more of in a distribution business, or, has some high pass-through costs, the revenue number might be much larger. So we think of it more around sort of the gross profit and looking at the other public companies. I mean, there are sectors where pre-revenue companies get public all the time, like biotech would be the obvious one. We don't invest in biotech on a direct basis. We do through funds, but not directly. So we're really looking at, the appetite of the public market, for that sector. And there's some companies that would look to have, the scale, but we just don't think they're good public companies. And a good public company, I mean, that's a tricky one, but one of the biggest things is predictability. So if your quarters are kind of all over the map, you have customer concentration, lumpy contracts, it's going to be painful to be a public company. And so, we're looking for companies that have the scale that gives them quarterly stability, and how big they need to be really depends on, like if it's a model where their transaction size is very small, it's a recurring, revenue company, that's going to be easier to come out at a much slower level than if you've got very lumpy, large contracts, maybe non-recurring. You just need to get a lot bigger to get smoothness. And then the team. I mean, some teams are great teams. They run great companies. They're not going to be streetable. I mean, we made up this word streetable. We just think there's management teams that just aren't streetable. They're not going to play well with Wall Street. There's some of those CEOs that are public. I won't name any, but I'm sure, you can all think of some that just don't quite believe in the SEC's rules, and they get themselves in a lot of hot water on a regular basis. Like, they can get public, but again, probably not the best.
Probably shouldn't be public.
Which is
so really interesting.
We're looking for the management teams where the CEO and CFO are going to do well as public companies, and the financial model is going to work well, because the multiple you're going to get, whether it's a multiple of revenue or EBITDA or whatever multiple you're looking at, the multiple you're going to get as a public company, has a lot of factors, but one of them is just, how well you've kind of played the meet and beat game.
Yeah.
And so if we don't think they can do that well, then we'll usually not recommend that path. And we try and buy companies that we think IPO is a good path, maybe not the right path, but a good path. But sometimes we change our mind. Sometimes after some experience with the companies, we're actually the ones saying, as the kind of public expert around the table, we think this is not a good idea.
Yeah. That's super interesting. How often are you spending time kind of reshuffling the management team, bringing in new management, all that type of stuff? Because I imagine, like, it's a whole different management team it's a whole different set of skills that a management team would need to run a public company versus a private company. It could still be the same people, but how often are you changing that up or looking at that?
Well, we're pretty late and we're pretty passive. And so we specifically probably aren't really ever doing that. But in terms of the companies we invest in, most of the time that's already happened. So when we're selecting our companies, we want the team in place that is treatable. Now, maybe there's a person missing. Sometimes we have made investments where we knew there was a board search for that public, caliber or public experience CEO, or a lot of times they don't have a public experience CFO yet. So, but they know what they're looking for. They're committed to bringing in, that type of a team. But I would say the majority of the time we're investing in the team we think can take it public for the most part.
Yeah.
That's a key part of our criteria.
This is kind of a question on a left field, but I was reading about this recently. What do you think of the Texas Stock Exchange being based in Dallas? It doesn't seem like they got a lot of money behind it, at least what I was reading. This has been tried before. Other stock exchanges, right? Still NASDAQ and New York Stock Exchange are dominant. What do you make of that?
I haven't read a ton or have a big opinion. I mean, there's been so many runs at, some of the European exchanges, trying to really, most of the European companies still come in the US, right? The tech companies, at least. The Australian exchange, remember they got some very small cap US companies to go public in Australia. And I mean, look, good on them. I hope but I'm just skeptical. I just think it's hard. I mean, it's just such a.
Do you think it's hard because it's not New York? Because New York really is kind of like that force multiplier that maybe.
I think it's just a network effect issue.
Yeah.
I mean, look, NASDAQ's not really anywhere, although certainly they have a presence in New York. I mean, it's an online exchange, right? I just think it's scale and like even look at like the Amex and the London and pretty credible. It's hard. I think I think it's just that network effect and just really hard for a new player to really break in to that space. But maybe if it's a niche, focus on. I'm not that familiar with their particular plans there. Look, I think the more, the one thing that has been interesting is the different ways to go public. I mean, I think the sort of direct listings, obviously the SPACs, the auction, the Dutch auction processes we've seen.
Yeah.
I think there's been a lot more innovation in how you get public maybe than the exchange.
What was your take on the SPAC kind of revolution that lasted maybe like 2 years?
Yeah. I mean, look, SPACs have been around forever. It wasn't new, but this sort of just huge surge and people raising SPACs for all kinds of things was really surprising. Like I like, where did these things come from? It was sort of a craze, and it's always hard to explain why those things happen, why they make sense to anybody for a minute. Look, it was sort of post.com. There was some companies that had been hit hard by .com, and that seemed like an interesting way for them to sort of get out, is to merge into one of these shells. But then when there's all these shells being raised around, teams with varying levels of experience, and we're going to go do something, like, I never understood why that was interesting, like, versus investing in a fund. Like, it's this super concentrated, investing in a fund is investing in a, basically a dark pool to begin with, and then investing in a dark pool that's going to have one asset that's unnamed. Like, it really never made any sense to me. And then I don't know how all these people spending all this money raising these SPACs, not the D-SPAC, but the original SPAC, like, how they all just glossed over the redemption provision. Like, did they really just think that, oh, no one will ever redeem? Well, now, like, I think most of them are done now, but like the redemptions got up to like 95% plus. Like, so all that money that was spent raising those pools, and then when they finally announced their target, everyone just redeemed. It was just such a waste of time and money.
Yeah. It seemed like 2010s, it was software was kind of like the focus. and before that too, but like software companies, particularly software as a service companies, were doing really well. Consumer tech companies, those types of things. It does seem like we might be in a bit of a shift because of AI and other things away from strictly software companies. And when I look at it, I think like energy companies might be like, what do you think? Like, what's the next like place that people are going to continue to innovate or expand or see a lot of value created? And is it going to stay software tech, or do you think it
within venture?
Yeah, within venture.
I mean, venture's expanded a lot in terms of their sectors that they're impacting. Back in the day, it was obviously healthcare. Biotech's always been a meaningful part of venture, and then sort of software and hardware. Look, I mean, I think, fintech has been a big category where I think, core payments and banking. Look at all the venture names that have come out of payments and banking, which just was not an area that venture really played when I started. I mean, ed tech, we've seen, a fair bit. Prop tech, those just weren't categories that venture was playing. So I think, but within technology, I mean, software is always going to be a big part of it. I think software does still rule the world to some extent. And, AI, is software. So it's sort of a version of software. But AI is impacting a lot of companies, a lot of industries out sort of the traditional norms. And everyone thinks tech with AI, but I actually think that biotech is, maybe more affected more quickly, than a lot of other software industries. If you look at, if you look at, some of the breakthroughs that they've made in biotech with AI, I think there could be some really big, there can be some really big impacts in sectors that most people don't think of when they're thinking about the AI impact.
When you look at like the opportunities that are going to exist and kind of where we're going to need a lot of resources, is it weird that there's not a lot of energy VCs, like energy specific VCs, or is it just like so much money is needed in order to get in there? We have a really cool energy company in Turo that Nate Walkingshaw is doing that I think is incredible. But like what's the most valuable company in the world? Is like Tesla is kind of getting up there, like, which I would put as an energy company. Like, why aren't we seeing early stage energy VCs or Series A, Series B, or do we have them and I just don't know?
Well, I don't know that we have a lot local. There are some interesting things happening here around energy. Obviously, Taurus and Zanskar is a super interesting name that some of our manager invested in the geothermal space. We obviously have the big geothermal project down south that's received a lot of funding. But in general, I would say with energy, it's more the land of private equity than venture because the capital intensity has traditionally been so high. So when you talk about, building geothermal plants, it's more it's more of a private equity play. And there are a lot of very large private equity funds playing in all types of energy, traditional energy, but also, all kinds of alternative energy and climate and green plays. I think there's certainly some venture funds. We've recently boiled the ocean and looked at dozens and dozens of sort of climate-focused funds, which is partly energy, but there's other elements of some are energy specific, some are, a little different, but most of them have some energy component. So I think there's a lot going on, but I think the VCs are trying. I mean, look, Green Growth 1.0 was like a disaster. The venture funds, I don't think there were any winners. Maybe some punted, but I don't think there were any winners. So that was painful. I think mostly they learned that it's capital intense and that the world didn't move nearly as quickly to sort of, green energy as they'd hoped. But there's a whole new wave of those funds, and we'll see. I think the jury's out. It's just too soon to see how they do. But I think they're all trying to figure out how to create a venture model around energy and find, software plays, technology plays that are not infrastructure energy, which, I think just doesn't, probably give venture returns. And it really requires leverage and big capital. And I think the land of private equity.
Karey, so great to see you. So great to talk to you as always. Is there anything you're working on that we should promote or if anybody's trying to go public, they already know about you. So,
Well, I mean, like I said, we're not regional. I'm not sure where your listeners are, but Utah or anywhere else, we're always looking for, we're looking for opportunities and companies that, are further along. And look, we love to engage with people a click soon. And if they're not quite ready for us as a direct investor, we make a lot of introductions to our other sort of funds. We have investment partnerships with, over 70 managers, I think now. So
wow.
Always happy to help companies identify who might be the right partner for the stage or sector that they are in. And, when they get to our stage, if they think an IPO is really where they should and want to explore, always happy to get to know companies. We'd love to see some more IPOs come out of Utah. We don't get a lot of opportunities to invest in pre-IPO names here. And, we've had some mixed results on companies getting out. We'd love to see some companies, get out, stay public and just perform and, have a crop of sort of very successful public companies here in Utah. So we'd love to assist anybody that wants to go on that journey. So, and fund wise, I mean, we have there's lots and lots of funds out there. So we're not, we've got great partnerships, so we don't add many new managers, but look, always looking to partner with the best and brightest across, companies and funds.
Incredible. Karey, thank you so much.
Thank you. It was really a pleasure. Thanks for the invitation.
Likewise.